Okay. Well, welcome to our webinar today. The title is called Maximize Your Capital by Trading Derivatives. Those of you that don't know me, my name is Sean van den Berg. I am Head of Client Education at PSG Wealth. First of all, from my side, thank you for taking out the time out of your busy schedule to be on this webinar. We really appreciate your interest and your support. So this webinar is being recorded, and the PDF as well as the recording will be sent out tomorrow. There will be time for questions near the end of the presentation. All you have to do is type in your questions in the question box. Okay, so the topic today is maximize your capital by trading derivatives. Talking about derivatives, here's a quote from an author called Zaid Abdel-Nour. He said that at $4 trillion and roughly only $55 billion in equity, the Fed, that is the US Federal Reserve, is leveraged about 77 to 1. They define the word leverage. So that is our main gist of the presentation today, is using leverage, especially obviously with derivatives. So why are we talking about leverage? First of all, let's look at the current situation for a lot of people here in South Africa. The current position, we've seen already global economy slowing down. South Africa's economy is slowing down. We've seen interest rates starting to go up. The consumer is feeling the pinch. We've seen the rand weaken. So if you look at the rand, the parity, you're getting less for your rand. You're taking a bit of a pay cut if you look at it in dollar terms. So some of us might be finding that we got more month at the end of the money. The banks are not letting out any more credit as easy as they used to. So many investors or traders are also saying they're very frustrated and worried. So saying that's the current situation. What is the ideal situation? So the gist of today's presentation, where we want to be is get our money to work harder for us. That's number one. And number two is obviously use leverage, especially leverage around trading derivatives, or especially with derivatives. What does that help? What does that mean to us at the end of the day? Hopefully it translates into us making more money with the money we've got, which hopefully leads to being more consistently profitable as a trader, and ultimately, obviously, financial freedom. And my definition always is to achieve true wealth is having financial freedom as well as time freedom. When I say time freedom, is being able to spend more time with your family, doing the things that you enjoy. I love to be playing more golf. I love triathlons, so it's spending more time with triathlons. But ultimately, obviously, from my trading activities, passing that some of those funds through to my longer-term investment portfolio so I can have a happy retirement in my golden years. Okay, so that is where we want to be, and how do we get there? Okay, we spoke about leverage. What is leverage? Many of you maybe have bought a house before. If you looked at a nice house, let's say, for example, you're an investor, let's take it that way, and you want to buy some properties, and you've got, you're looking at some townhouses. So you might have 500,000 Rand cash and you go buy the property. Okay, a lot of people are not in that situation. They might have 50,000 Rand and they put down the initial deposit and they borrow the remainder of the money from the banks. So we're putting down roughly about 10% to have exposure of 100%. Same as buying a car. You're using leverage there where you want to go buy a new Merc C180, also about 500,000. Again, put down 500,000 Rand. You can walk out there straight away with the car, or put down an initial deposit, 10%, 50,000, and obviously finance the rest or borrow the rest of the money. So that is in the sense what the leverage is all about. So what are we proposing today is, while we're trading derivatives, there's a broader range of derivatives that PSG Wealth offers. First of all, contracts for difference, single stock futures, index futures, and currency futures. I'll go into more detail in the following slides on those things, the pros and cons on those derivative products. But all these derivative products, number one is to say that they're capital efficient. And that's where the main thing is going to talk about today is leveraging. The capital efficient, you don't need so much money to get started. So it makes it more, you can say it's more affordable for more people to get involved in the markets. That's number one. And number two, obviously, it gives you more flexibility. You're going to have more positions open with less money. You got more liquidity. These products are very tradable, very liquid, and you also have the opportunity to make high returns. And another thing about the derivative products, compared to equities, trading equity, they have low trading costs. Okay, so that's just one of the things we're proposing. So let's go into the advantages and disadvantages of each of these products. Advantages are, say, capital efficient. You don't need a lot of money to invest in CFDs, but there are certain requirements. First of all, the minimum exposure is 25,000 Rand. So if you look at on the right hand side here under disadvantages, you put out an initial deposit of 15%. That's for a top 40 stock. We only trade, by the way, the top 100 companies on the JSE. PSG, we're looking at companies that are tradable, companies that are liquid, that you can get in and out very fast, but also a bit of quality companies. So if it's a top 40 company, we require you to put on a 15% margin, which is roughly about 3,750 Rand. If it's the next 60 companies, or from 41 to 100, the margin requirement is slightly higher, so we're asking for a bigger deposit, 17.5%, or 4,375 Rand. As long as the transaction value is 25,000, the system let the transaction go through. Okay, so CFDs are very simple products. It's like trading a normal share. As I say, only a big difference is instead of outlaying 100%, you're putting down an initial margin. But also compared to equities, remember on PSG, we work on a sliding scale, 0.9% for the first 25,000. Yeah, we're working on 0.4% plus VAT. That's how simple it is. Okay. The advantage of trading CFDs, there's no expiry as compared to single stock futures where they do have a life. So this saves you on rollover costs, which equates to roughly equates to 1% annual savings you're making there. So this is ideal. CFDs are ideal for the position trader. We'll talk about position trading a bit later, but for more of a longer term active investor, if you look at it as a position trader. You can also hedge your portfolio using CFDs, but I've got a question mark there because you must understand there is a cost involved. We call it scrip lending fees. It's 1.5% per annum or a minimum of 250 Rand. So just be aware there are additional costs with if you want to hedge your portfolio. Hedge your portfolio. I've got a share portfolio and anticipating the market to pull back. So I don't want to lose money on my portfolio. So I use CFDs and single stock futures to hedge. So what I lose on the share portfolio, make up by going short on the derivative products. What I lose on the swings, I make up on the roundabouts. That's what they call a hedge. But also with with CFDs, by the way, I've got all the full benefits like trading normal equities. So I've got a capital growth as well as also the dividend income. Now remember, as a CFD, in the CFD contract, you're receiving a synthetic dividend. Remember, you're not a shareholder, so you do not have voting rights. Okay, so you can have 1,000 shares or contracts on Sasol, but you can't go vote at the AGM because you're not a shareholder. Okay, so remember, you received that synthetic dividend. By the way, so you must excuse, there's a big storm going on outside here, so there's thunder and lightning. Okay, so you remember the receiver classifies all derivatives as taxable income. Okay, so you can't say this is capital growth or capital nature. It will be income. With regards to CFD platform, you have access to placing orders after hours or outside market hours. And the nice thing about it, saves you time. If the market moves up and the order gets triggered during the market, so it saves you time. Also, you can also place in your stops and things like that. We talk about a entry price, a take profit price, as well as a stop loss price. And remember, all our prices on our trading floor, on our trading platform, is what is called direct market access. The prices you see flashing on your screen in your order book is what's happening at the JSE. Those prices are real, but there's no delay in placing orders. There's no supervisor looking at you got the funds available. The risk management system automatically looks at it for you. So that's some of the advantages regarding trading CFDs. Remember, so it's not for everyone. On the disadvantage side, it's not for everyone in the sense that you need a lot more capital to get started with. And also, obviously, there's additional costs going with regards to going short. If I'm putting down roughly about 15% deposit, I'm borrowing the other 85%. Okay, so there is a cost involved there. We charge the prime interest rate. What's that? 10.25%, less the 2%. But it's very, very affordable. To sort of understand if CFDs, the costs are very low, interest rates might be a bit higher. With single stock futures over around, where the trading costs are slightly bit higher, but the borrowing costs are much lower because you're trading through market makers. And then lastly, as a disadvantage, you might look at gearing and risk as a disadvantage. But if you understand how they work, obviously it'd be more in your favor. It is a risk. Everybody understands the initial margin, putting down a 15% deposit, but I need to keep that ring fenced. So that 15%, I have to keep it on a daily basis, what we call mark to market. So in the afternoon when the market closes, we see where the market has moved. It's moved in your favor. The money will be put in your account tonight. So I bought something at 5 rands, moved up to 10 rand. That 5 rand will be in my account tonight. If the market moves against me, you need to top up the next day. Okay, that 5 rand difference. So this is where what we call variation margin. So that's what I call top up. It's for adverse price movement. So it's not only your initial margin you have to have in your account, as well as variation margin. Okay, so that is a risk if you don't understand how that works. So it's very important to get your head around that concept. So that is, in a very nutshell, a very simple nutshell, contracts for difference. As I say, any questions you have, type in the box and I'll be able to answer at the end of the presentation. Let's look at single stock futures. The big difference between the two of them, between contracts for difference and single stock futures, contracts for difference is a contract between PSG and you, the client. Okay, so they're not regulators, what we call OTC product, it trades over the counter. Whereas single stock futures, it's a regulated product. We trade with standardized contracts. So the minimum you can buy is one contract. And one contract is equal to 100 shares. So again, they're very capital efficient. And you'll see that they're actually more affordable for a lot of people because it's rand value contracts. Also, a low trading cost compared to trading as equities. And this is where I suggest you want to use use single stock futures to hedge your portfolio because there's no script lending fees involved here. So it's a cheaper option. Okay, so you can open up a single stock futures account and a CFD account, and then obviously move the funds between the two of them. Very similar to CFDs. Also have DMA. You can place your orders after hours, and you have that stops in place. As I say, the costs are slightly bit higher in the sense that it's 0.4% brokerage plus 0.1 market makers commission, and then VAT on top of that 0.5%. Okay, that on top of that those brokerages, and then you also have what they call a booking fee at 60 rand. It's only on the purchasing leg of the transaction. So if you buy Sassel now, one contract now, and 10 minutes later another contract, you only pay that booking fee once. If you buy today one contract and you buy another contract tomorrow, you charge that booking fee twice. That 60 rand booking fee. That is a percentage of your costs, can push it up higher. So just be aware of that. Okay. So if I'm putting down 15% deposits, roughly about 15% when it comes to single stock futures. You see sometimes a bit lower, give you bigger bang for your buck. But I'm borrowing the other money, the other funds to invest to have full 100% exposure. Now you're trading through market makers, which are the banks, and so they're competing for your money. So the interest rate with single stock futures is lower than compared to CFDs. There's only one other additional cost when it comes to single stock futures. They have a life. They trade over about 90 days, so there's a quarterly rolling fee, 0.25% of your exposure per security. So 0.25%. So as I say, they do have a life in the sense that the third Thursday of every month, like next week Thursday, we'll be rolling over the March contract into the June contract. So the futures, the JSE has their futures close out on the Thursday. We usually roll over on the Monday. Okay, so the third Thursday of every quarter, March, June, September, and December, we have a futures closeout. At PSG, we trade what they call dividend neutral contracts. They don't compared to single stock to CFDs. With CFDs, you receive the synthetic dividend. With dividend neutral contracts, single stock futures, it's priced in, so you don't actually receive it. Okay, that's a big difference. So if you want to actually receive the dividends, maybe look at CFDs. Again, you can have 1,000 contracts on Sasol. You are not a shareholder. You cannot vote at the AGM. And again, it could be a disadvantage if you don't understand how the gearing works. Okay, so those are the two what I call equity-based derivatives. Let's go into index-based futures. So first of all, we talk about the All-Z. So it's a futures contract based on the top 40 index. As the large cap stocks, so through one share, like the Satrix 40, which is the ETF, through one exchange traded fund, through one share, you have access to a basket of shares. But now we're trading the index. So what's nice about it, and the same with the single stock futures and CFDs, we talk about going long, we take advantage of rising prices, we talk about going short. So that's just some of the terminology. So I used the example just now, buy something at 5 Rand and sells at 10 Rand, that's going long. If I want to take advantage of a falling market, I sell at 10 Rand and I buy back at 5 Rand. I'm still making my 5 Rand. So that's why we talk about going short. That's also what I meant by hedging a bit earlier. What's nice about the index futures, or especially the All-Z, they are cheap. Okay, low cost. It costs you 25 Rand. That includes VAT per All-Z contract. Now that's having exposure. Let's say, for example, the market's trading at 40,000 points times 10. So it's 400,000. That's your exposure. 400,000 Rand. It's only going to cost you 25 Rand. With index futures, there's that 60 Rand booking fee doesn't apply here. What's nice about the index futures, they are very popular, so the spreads, the difference between the bids and offers are very, very narrow, a few points. Okay, just also understand regarding index futures, the futures market opens 8:30 in the morning and closes at 5:30. There's an additional hour of trading as compared to the equity market. Just understand you're trading through market makers. So in the morning, just be aware that the market makers might not be trading yet. So those spreads might be a bit wider outside JSE trading hours, especially in afternoons, 5 o'clock in the afternoon. The bankers, market makers might pull their orders. That's why the spreads might widen. Not so much in the All-Z, but just be careful on the All-Me, which I'll be talking on the next slide. Each index point is worth 10 Rand. So traders, and this is ideal for they call the day traders. They'll try and grab 100 point from each trade, and that 100 point equates to 1,000 Rand profit or loss. Okay. Anything about index futures, and this is for the more advanced trader, you need a lot of capital. So at the moment, the margin required for the March contract is 29,560 Rand. And I know for the June contract, I think it's another 30 Rand on top of that. So 29,590 Rand for the June contract. But each point, your profit or loss depends on the market moving in and out your favor. If it goes up 10 points, obviously you made 50 Rand, and vice versa. Just understand that each move is 10 Rand. The index futures, by the way, they do close out. So there is expiry date. You can't roll them over into the next contract. They physically close them out. But you usually find that, especially right now on our platform, if you want to go trade right now, you'll see there's a June contract and the March contract available. I suggest obviously you trade the March contract. You see the prices are slightly bit higher because obviously more interest involved. Okay. So the All-Me is the mini version of the All-Z. So we're talking about 10% of that. So I used the example just now, 40,000 points. So your exposure, instead of looking at 400,000 Rand, your exposure is only 40,000. Again, you're trading for your market maker. Liquidity is improving as more and more people get involved with it, and those spreads also between the bids and offers are improving. But each point now in this situation is 1 Rand. Okay, and each contract is 85 Rand. Again, no booking fee. Your margin at this point in time for the March contract, 2,956 Rand. For the June contract, 2,900 and 30 Rand on top of that. Okay, another 86 Rand. Okay, they do close out, so just remember, go look at the 2 contracts at the moment and go for the longer term contract. Let's talk about currency futures. Again, this is ideal for the day traders. Someone doesn't hold a position overnight. Currency futures allows the local trader to have exposure to foreign currency movements. So the dollar, the euro, the pound, those are the 3 big ones relative to the rand. So you're not taking any money out of the country. It doesn't affect your offshore allowance. Just be aware of that, number 1. Number 2, we trade 1,000 of the underlying. That's the contract size. So it's $1,000, 1,000 euros, 1,000 British pound. So that's always against the rand. Okay, so again, we talk about going long and going short, and this is where it does get a bit confusing regarding the transactions. Always remember, it's from the foreign currency version to us. So if I want to go long, I'm going to be buying the dollar, which means, remember, I'm trading a currency pair. If I buy the dollar, I'm automatically selling the rand. If I'm buying the rand, okay, I'm automatically selling the dollar. So that's when I want to go short. So if I want to go short, anticipate that the rand's going to get, that the dollar's going to get weaker, I'll go sell the dollar. So it's a geared product in the sense that you do not have to deposit the full amount. So it's a fixed rand amount per contract. So, for example, the June contract at the moment, you put down 1,570 rand. That's the margin, initial margin required. And that equates roughly to about 10%. In this situation, it actually equates to 9.8%. So this is a few yesterday about lunchtime when I looked at the spot price of rand, 15.3949 times 1,000. Remember that the size times the that's what the contract value be worth. That divided by the margin, you can see is roughly about 9.8%. So again, every point is worth 10 rand. So again, you want to go for a 10-point move. In this scenario, we create 1,000 rand. Okay, very cheap still, got a very low trading cost. It only costs you 20 rand, and that includes VAT. And by the way, if it's a day trade, you close the position, you close your position out in the 1 day. Remember, this is, by the way, 20 rand for purchasing and 20 rand to close out. If it's a day trade, you only pay you only pay the 1 leg. You only pay 20 rand. So that's what it makes it a bit more enticing for the day traders. Okay, so what does all this mean to you? How can we benefit from it? So here's a quote from Dr. Alexander Elder, and a lot of you have seen me talk about Dr. Alexander Elder before, but he wrote a book called Trading for a Living. The goal of a successful trader is to make the best trades. Money is secondary. So my goal as a trader, for example, is to become a consistently profitable trader. Money will take care of itself. So let's get into the benefits. A lot of you have seen this before. Then I compare investing to trading. I'm running out of time, so I can talk a bit faster. So investing, your time horizon 3 years plus. As a trader, it's anything less than 3 years. And obviously that whole fits in you with capital gains. With derivatives, it's all taxable. Okay. So from a time management point of view, again, trading is not for everybody. You need much more time. So we talk about trading, we talk about active management. So whereas the focus with investing, I want to build a balanced portfolio that might consist of quality, undervalued, and safe stocks. My number one goal is risk management, risk and money management. Talking about risk, it's stop loss, and money management, talking about position sizing. So it's not about maximizing my returns, as minimizing my losses. That's where my main focus is, and then the money will take care of itself. Investing, it's more fundamentals. Yeah, it's technical analysis. Timing is your critical success factor. Yeah, I'm buying and holding. Yeah, I'm talking about buying and selling. And there's different styles. We talk about position trading. We already spoke about CFDs. Swing trading can be for single stock futures and CFDs. Day trading, currency futures, and the index futures. As an investor, conservatively, my goal is to grow my portfolio by at least 15% per annum. And obviously, I also want to add on my 5% dividend income and grow from that dividend. As a trader, I look at trying to make 15% per month. If I'm putting roughly about 15% margin down, I'm looking at doubling my margin or getting 100% returns on my margin. So you're talking about 80% per annum. The trick is doing this consistently. So yeah, we talk about buy low and sell high, take advantage of cycles. You can also talk about buy high and sell higher. That's a strategy called momentum trading. And especially with derivatives, I can sell high and buy low. It's all different strategies you can use. I'm not going to go into strategies today. We've spoken about it before. But especially when it comes to derivatives, you got very low trading costs. And just remember that your profits are eligible for income tax. So that's just to give you a bit of a nutshell overview of what is the benefits of trading. So we talked just now about capital efficient. So talking about leverage, bring down 50% margin to give 100% exposure. So you're getting 6 times gearing roughly. So if the underlying share moves up R1, your derivative product moves up R6. So if you understand that relationship, then you understand how gearing works. So, but let's also look at a practical example. This is yesterday, we're talking about British American Tobacco, BTI. They were trading at 870. Okay, so if you had to go buy 100 shares, you would have had to outlay 87,000 Rand to have that 100 share exposure. With a single stock future, to buy one contract, which is equivalent of 100 shares, I only need to put on 5,806 Rand. So my gearing is 14.98%, 14.98 times. If the share moves up R1, my derivative moves 14.98. Okay, so you understand that relationship. That's why the advanced traders get excited, because I can understand I can maximize my capital more efficiently. And if I look at some of the differences, and this is the main thing I want to highlight, is you can get a bigger bang for your buck with single stock futures. I go buy 100 BTI shares, like with the shares, but with CFDs, I'm bringing down 15% margin. 15% of that is 13,000 Rand. So my gearing, my leverage in this scenario is 6.67 times. Same scenario, I go buy one contract, you can see it's much higher. Okay, if the price goes up, my gearing with single stock futures still stays the same. If the price goes up with CFDs, if the price goes up with single stock futures, my gearing increases. However, if the price falls, my gearing still stays the same. Okay, so it drops to 800 Rand a share, my gearing still remains the same. However, with single stock future, that does drop. So just understand, when the price goes up in your favor, or if the price goes up, the gearing works. You get a bigger bang for your buck with single stock futures. You do have a high return, so that's one of the big benefits of trading. But again, the higher the potential returns or rewards, the higher potential risk. Very important that you manage that risk. Okay, we have spoken in previous webinars how to do that, using stop loss, using position trading and things like that. But trading derivatives gives you a lot of flexibility. You don't have to have only one position open. You can have quite a few different positions, and also you got it's high liquidity. You can get out and trade as fast as you can. So you might have a lot of other little questions. Yeah, but I'm a novice investor. Should I invest or should I venture into trading derivatives? My first thing always is your number one investment is to educate yourself. Your goal is to gain confidence. Number one, your stock picking abilities, and number two, obviously understand how the platform works. So there are a lot of webinars available in our archives regarding past derivative products. There's also tutorials you can go through, especially on the technical analysis side. But to gain more practical experience, you can do paper trading. So there's a single stock futures simulator, and mainly obviously at the index futures. But you can also do a paper trade on an Excel spreadsheet. What if I go open up a contract there at these levels? What would it be? But the best experience is to start small. So I'm going to take out one little contract, and you'll see some examples just now. Some of these contracts are negligible. So here's a little quote from Warren Buffett. So coming back to the novice trader. When you combine ignorance and leverage, you get some pretty interesting results. Okay. So I know Warren Buffett has also said a lot of other things about leverage and derivatives and things like that. But this is one little interesting one in that one. I only have 10,000 Rand to start trading. Okay, so some of you might be in that scenario. Should I trade single stock futures? The ideal situation, you guys heard me before, is the bigger the capital you got, the better, because it gives you more flexibility. So I always suggest 100,000 plus, especially when it comes to position sizing. We talk about allocating 2% risk per trade. So 2% on 100,000 is 2,000 Rand. That's the most you should ever lose on a trade. Now 2% on 10,000 Rand is 200 Rand. So it's much less, so you get less flexibility. But let's say, for example, you've only got 10,000 Rand. You can go buy equity trade, you can go buy 200 shares. Okay, this is talking about Old Mutual, by the way, at 41 Rand 73 yesterday. So your exposure would have been 83,000 Rand times 0.9%, would have been 75 Rand brokerage. However, our minimum brokerage is 98 Rand. But you can take that same scenario and go look at any of these trades. Look at the margin required per contract. So if you had to go, as I say, with Old Mutual, I can go buy 2 contracts. Okay, same scenario, and my exposure, my capital outlay is much less. I can have more positions open. I can have maybe 3 or 4 of these shares in my portfolio. So that's one way of diversifying 10,000 Rand to different shares by using single stocks. And that's one way of looking at it. Okay. Guys, I'm running out of time, so I'm going to talk slightly bit faster. How long should I hold a position for? Again, difficult one, but a day trader holds a position from, doesn't hold a position longer than intraday. I close out my position in the afternoon. So that's ideal for the index and currency futures. Swing traders holds a position from 2 days to 30 days, ideal for the single stock futures and CFDs. And then lastly, position trader holds a position from 1 month, okay, to a few years. So that's ideally for the CFDs. If you look at longer than 3 months, remember the single stock futures as 3 months before its expiry. What about technical analysis? What would you suggest? If you open up a single stock futures account with PSG, you got to use it. You got a account number. That'll be your username and password. You can download. You can click on this link here and download what we call Swordfish, ideal for Aussie and Ormi trading. Those of you a bit more swing traders or position traders, you might want to use some end of day programs. Our own Win Professional Plus you can use. And then Metastock. I've been using Metastock for many years. You can get it from PDSnet, and you also get it from Dave Jackson at Traders Edge. And then you combine both together, more advanced program called VectorVest. You can click on those links. Okay. So let me see what questions you guys have. Okay, lots of questions here. Also, is a question from France Snyders. I appreciate all the questions, guys. And I know I've gone over time, so if you just bear with me. Is the Aussie Mini version also available on the Yes, the Aussie Mini. It's called the Ormi. Yes, France, it's available there. So the margin required much lower, 10% of the Aussie version, and obviously the cost is much lower. Reynold, here's a question from you. Is there a similar available? Yes, for the index futures at this point in time. We are working on bringing some more into a later stage. But as I said, use an Excel spreadsheet. Leondit, is the initial margin required per contract? Yes. Okay, I hope that answers your question. Okay, so that's if it's a CFD on about 100 shares on British American Tobacco, instead of putting on 87,000 Rand, my initial margin is 15% of that, 13,000 Rand. And you'll have the Rand value for contract for British American Tobacco. Okay. When it's trading equities, how do you size your position? Clive, position sizing is more for derivatives to take advantage of that leverage. So it doesn't really apply to trading equities as such. But obviously you have to take into consideration your costs. 10,000 Rand, the brokerage is of 98 Rand, your cost is roughly about 1%. So at least a minimum of 10,000 Rand per trade on the equities. But position sizing from a risk management point of view, it works more for the derivative products. Yeah. Daddy Moore, thank you. Appreciate it. Have a great day. Great. Leonard, I hope that answered, and thanks for being on this webinar. There's a question from Sanda. If I have 5,000 Rand to start trading, which derivative trading can I use that will have a faster growth? Okay. Obviously, you're limited. You won't be able to trade the index Aussie. You might be able to trade the one contract on the Ormi. I suggest you start with single stock futures, and there's a whole list. Go through the list on our website. You'll see, and when you get this presentation, see some of those examples with the margin required much lower. So I hope that answers your question. So single stock futures. Okay, that looks like it's all the questions. Thanks a lot. Awesome. Okay, just quickly to wrap it up. Okay, what you must remember from this presentation, leverage is the double-edged sword. If the market moves in your favor, great, you're making money. Money moves against you. Just understand that the variation margin you top up. So it's a double-edged sword. Understand how that works, then you'll be way ahead of the crowd. Benefits of trading derivatives: yes, capital efficient, low trading costs. You can trade direction. You can go long and short. Doesn't matter what's happening in the market. You'll always be able to make money. But the main thing I want to highlight for you guys is to educate yourself. The main idea there is for you to gain confidence, and one, in understanding how the products work. Secondly, in your trading strategies, and thirdly, obviously, your technical charts. To where you from now, I suggest you guys register for the derivative trading account. Doesn't cost you anything extra. So, compared to an equity account, we have to pay a 40 Rand monthly admin fee. There's no cost involved. But open it up if you're serious about trading these products. Single stock futures, CFDs, currency futures. By the way, index futures will be part of single stock futures. So click on those links to give you some more information. Please, if I can ask you, please provide some follow-up feedback. I'll be sending out the survey tomorrow. Any questions you have, you can also ask our client services guys. Okay, so just from my side, thank you very much for being on this webinar. Those of you in Pretoria next week, I'll be discussing how do you leverage your local share portfolio by using a product called ScriptFin. And also, we were talking about investing offshore, and I have the guys from PSG Asset Management talking about their view on investing offshore. So please come along. There's still lots of space available. Those of you in Centurion. Next week, we'll be talking about are you worried about tax and estate planning benefits? The week after that, I'm on holiday, but the last Wednesday in March, we're talking about property ETFs. So I've got the guys from Grindrod coming to talk about the core shares. In April, so far, we're talking about investing offshore. And just to clarify for you guys, are you investor or trader, and the products around that. Okay, but thank you very much for being on this webinar. I hope you guys gain benefits from it. There's my contact details. Drop me an email if you want some further clarification. And yeah, enjoy the rest of your day. But from my side, thank you very much. Until next week, all the best. Bye for now.